And straight away, let's cut across live to RBI Governor Shaktikanta Das, who is addressing the media.
Utilization in the manufacturing sector is running above its long-term average. There is also some improvement in business sentiment. High-frequency indicators of services sector such as sales of commercial vehicles and freight traffic indicate moderation in activity. The MPC also noted that CPI inflation rose to 2.6% in February 2019 after 4 months of continuous decline. The upturn reflected an increase in prices of items excluding food and fuel and weaker momentum of deflation in the food group. Households' inflation expectations declined by 40 basis points each for the 3 months ahead and for 1 year ahead horizons. Manufacturing firms reported reduction in input price pressures. On India's external front, export growth remained weak in January and February 2019, while imports, especially non-oil gold imports, declined. The trade deficit narrowed in February 2019 to its lowest level in 17 months. Net FDI inflow were, however, strong, while foreign portfolio investors turned net buyers in domestic capital market in Q4 of 2018-19. India's foreign exchange reserves were at 412.9 billion on 31st March 2019. Taking into account these developments and looking ahead, the MPC revised the path of CPI inflation downwards to 2.4% in Q4 of 18-19, 2.9 to 3% in H1 of 19-20, and 3.5 to 3.8% in H2 of 19-20, with risks evenly balanced. GDP growth for 19-20 is projected at 7.2%, 6.8 to 7.1% in H1 of 19-20, and 7.3 to 7.4% in H2, with risks evenly balanced. Beyond the near term, the MPC assessed that the short-term outlook for food and fuel inflation remains benign, although there is some uncertainty around the prospects for the monsoon and seasonal reversals in the prices of some items. The outlook for oil prices continues to be hazy both on the upside and the downside. Inflation excluding food and fuel has remained elevated but has shown some moderation compared to first half of 2018-19. Financial markets remain volatile. The fiscal situation at the general government level requires careful monitoring. Overall, the output gap remains negative and therefore strengthening domestic growth impulses by spurring private investment assumes priority. To summarize, global growth is slowing down, and this is also reflected in 3 successive downward revisions made by the IMF in its projection of global growth for 2019. Domestic GDP growth is also estimated to slow in 2018-19, with high-frequency indicators suggesting slackening of urban and rural demand as well as investment activity. While bank credit is growing at 14.3%, it is not broad-based. Bank credit to micro and small industries, which are critical to employment and exports, was flat at 0.6%, and also credit to medium industries at 0.7%. Growth projections for 19-20 have accordingly been revised downwards from 7.4%, which we had projected earlier, to 7.2%. Retail inflation rose to 2.6% in February 19 from a low of 2% in January. However, the upturn has turned out to be 30 to 40 basis points lower than our projections made in the February policy. Accordingly, inflation projections have been recalibrated. As per our current projections, headline CPI inflation is projected at 3.8% in Q4 18-19. Against this backdrop, the MPC voted to reduce the policy rate by 25 basis points while maintaining a neutral stance. Going forward, the Reserve Bank will continue to watch the evolving macroeconomic situation and shall act in time and act decisively. With the inflation outlook remaining benign, the RBI will address the challenges to sustain growth of Indian economy while ensuring price stability on an enduring basis in pursuance of its mandate in the Reserve Bank of India Act. I would now like to address some developmental and regulatory policies which we have announced today. We have about 11 announcements. One, the liquidity coverage ratio, LCR. The first one relates to LCR, liquidity risk monitoring tools, and LCR disclosure standards. We have allowed an additional 2% of SLR to be reckoned as level 1 high quality liquid assets for the purpose of computing the LCR of banks. While this move will harmonize the liquidity requirements of banks with LCR, it will also immediately release additional liquidity for lending by the banks. It has also been decided to form a committee on development of housing finance securitization market. We are aware that well-functioning securitization markets can enable better management of credit and liquidity risks in the balance sheets of banks as well as non-bank mortgage originators, and in turn would help lower costs of mortgage finance in the economy. We have therefore decided...
That was Reserve Bank of India's Governor Shaktikanta Das addressing the media. We have with us now my colleague Sumit Chaturvedi, who joins us on the broadcast. Sumit Chaturvedi, largely on expected lines, 25 basis point cut is what the market is expecting, is what economists were expecting, and a neutral stance to go with it, and that's exactly what the RBI governor has delivered.
Well, absolutely. That's why the markets have also come down from their peak. Yesterday, the headline was, again, Sensex touching 39,000. A part of that rally was coming from 0.25% or 25 BPS rate cut, which was expected by the markets. Today it has happened, so that's why they have lost steam a bit. Second important thing here is that GDP growth forecast for FY19 has been revised as well from 7.4% to 7.2%. And this year, the GDP growth will be also remaining at 7.2%. That's another feature of this policy. The Monetary Policy Committee has voted 4:2 when it came to this kind of overall decision. That's one of the important aspects. But yes, it's a good relief coming for borrowers because 0.25% cut has been announced. It's a second consecutive cut, but at the first in the current financial year, which has started from April 1st this year. So it shows the way forward that the RBI is going at ease as far as the interest rates are concerned, giving some relief to borrowers. They want to increase liquidity in the markets, and that's why they want to push more and more money into the markets and in the hands of corporates and people. That's why 0.25% cut has been announced. Yes, it's on the expected lines, and it's going to be further ease some pressure on the borrowers, but a lot depends on when the banks pass on this relief, because last time also they were criticized that banks are not passing on this relief to borrowers. They are just keeping it with themselves, increasing their margins. This time pressure will be on them to pass it on to customers, especially when the elections are around the corner. Government will also prod them to pass on this relief to consumers of loan bank and other consumer loans and other kind of loans. And that's what is to be looked forward to. Back to you.